Good morning, everyone. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion, and I'm here with my guest today, Nick Colas from Data Trek Research. We're here today to talk about payrolls. It's Jobs Day, also Groundhog Day, but the big economic news is coming out in about 5 minutes. The street's expectations are that we added 185,000 jobs to non-farm payrolls in the month of January. The expectation is also that the unemployment rate ticked up a little bit. Could be an interesting report under the hood in a number of ways. We're expecting some revisions to previous months' reports. There's an important benchmark revision that comes out this month. But in general, we all just want to see if that labor market is chugging along, and if, in essence, Jerome Powell's assessment that he has time and space to wait on the first rate cut is indeed the correct assessment. So, Nick, let me kick it over to you. What we have this grab bag of interesting data that's going to come out in about 4 minutes now. What are you looking most closely at?
Definitely looking at the jobs number, the jobs created number first. As you said, we basically have just had our first recession freak out of the year with Powell's press conference on Wednesday, where the market for the first time said, we could be going into a recession here if Powell doesn't cut rates as quickly as we thought. That's a bit unfair, obviously. The job market's been very strong. Initial claims have been quite weak until the print yesterday. So I'm not looking for anything terribly surprising. As a matter of fact, I would probably guess that we get a very close to inline number. We've had some upside surprises over the last year, but I think we're going to get an inline number today, both on jobs created and unemployment rate. But I think the under the hood is going to be the interesting thing to focus on, because, as I said, the market's really worried that because we're not going to get a rate cut in March, maybe if the economy slips between now and then, and this number will tell us a lot about that, we might be heading into a recession or risk of recession. And so super important number today.
Yeah, for sure. For sure. How do you think we should be thinking about the headlines that have been hitting? One reason that there is an extra bit of nervousness is that layoffs have been more in the news than it feels like is typical. Is there any reason why you think we should take those headlines with a grain of salt, or?
Sure. I mean, if you look at the initial claims number yesterday, I think we came in at 224. The 2.5 or 2 year average is 219,000. So even though it was an uptick on the highest number since November in terms of claims yesterday, it's still largely in line with the 2 year average. We really haven't seen a big uptick in initial claims. It's been kind of flat for 2 years now. It's ebbed and flowed, but it's been kind of flat. And so I'm not particularly worried about any kind of sudden weakness in the labor market, at least from the claims level side. We'll just have to wait and see. You're right. Layoffs have been more in the news.
Gotcha. Okay. And what was your take watching Powell on Wednesday? Because the context of all of this, the big news, the big eco news earlier in the week, of course, was Jerome Powell delivered his press conference. They held rates at 5.25 to 5.5%. But the chair did something that's relatively unusual, which was come out and say, really in no uncertain terms, that it's pretty unlikely that they're going to move in March. He gave us a level of sort of near-term forward guidance that we're just not accustomed to. Was that a sensible move on the part of the chair?
It's a fascinating point. Powell has said in the past that he does get an early look at economic data when it's very close to a Fed meeting. And when he said that, I really wondered, did he hear the number today? Does he know the number that we're about to see at 8:30? Because he has said in the past that he does get an early look at these numbers when it's very close to a policy meeting. So we'll see if that was a tell. That was my first thought anyway.
Okay. All right. Fair enough. So we're heading down the pike. We're getting this number relatively soon. I know that I'll be very curious to look under the hood and see what the sector makeup is here, because we do continue to have this aspect of the market where things like healthcare, you might still say leisure and hospitality, really for sort of structural reasons need to keep adding jobs. So there's a bit of noise in here that may not give us the clearest picture of what's going on from a cyclical standpoint. But I will give you the numbers as soon as they populate, and there you go. Whoa! Okay, so we added 353,000 jobs in January, which blows away the estimate. And a lot of it on the private payroll side, 317,000. Okay, the unemployment rate stays unchanged at 3.7%. The street had been looking for potentially a tick upwards to 3.8%. Wow, my first takeaway is Chair looks kind of vindicated. Goes back to your point. What did Jay Powell know earlier this week? But my goodness, what's your impression of that nearly double what the street was looking for here, Nick?
That's a big wow. I mean, a big wow. Huge
Oh,
number. And as we were just talking about, now we know why Powell said what he said. The mystery is gone. We know why he did that. Look, even if we get revisions to this number, and we certainly will, the average revision last year through October was 42,000 to the downside. So even if we take the average revision into this number, it's still a huge number. This economy is clearly still creating some jobs, creating quite a few jobs, as a matter of fact. And it does vindicate Powell's position, and it kind of makes him, I mean, look, I'm not saying it makes him look smart because he obviously knew this number in retrospect, but it does show why he said what he said and why it was clearly the right call.
yeah, and I apologize for averting my gaze for a second here, but I do want to put up an intraday chart of what's going on in markets because there's some interesting stuff going on. There is your 10-year, and whoa, if you thought if you thought cuts were more imminent than previously expected because you were worried about regional bank jitters or what have you. The bond market sees a pretty doggone strong labor market, a pretty doggone strong economy, and they are clearly dialing those bets back in a relatively quick fashion here. I want to come back to something we were chatting about a little bit offline before we got into the number here, Nick. Reading through a lot of your great research in recent weeks, I keep seeing this theme in there. We are in a mid-cycle market. We're in a mid-cycle market. Oak trees. Howard Marks has this great thing. You never know where you're going, but you really ought to know where you are if you're trading these markets. And you say we're mid-cycle. So unpack that for us a little bit, Nick.
Sure. Mid-cycle means that we're not at the early part of a cycle, which is a recession and coming out of a recession. And we're not late cycle, meaning we don't know that the economy is slowing quickly. We haven't seen any data about that today, obviously being an example. And so it's the middle markets, the middle part of the cycle. And we've had periods like this before, 2012 to 2019, or 2003 to 2007, or 1995 to 1999. And mid-cycle markets are just like what we are experiencing today. We think the economy is going to weaken, but then it comes through okay. And then we get more recession fears, and then it comes through okay again. So this push and pull of recession worries and then not having to worry about recession is exactly the emblem or emblematic of mid-cycle markets. We're just seeing it right now today in a microcosm with a better than expected jobs number. And so the mid-cycle markets tend to be very good equity markets, 15 to 20% returns, very low volatility markets, VIX well below 20 for the most part, and markets where tech and U.S. stocks and large caps outperform small caps, non-U.S. stocks, and other sectors. That's exactly what we have right now. So everything lines up. We have a mid-cycle market where we'll always worry about recession because that's just what mid-cycle markets do. But as we're seeing today, the economy stays pretty strong. That's a mid-cycle market.
Yeah, and in this particular mid-cycle market, we had about 1 day of recession jitters, and boy, do I expect that this will allay a lot of people's fears, seeing a job seeing a jobs number like this. Of course, there is always this this push and pull in a market like this. On the one hand, people say, okay, strong economy, take down those recession bets. On the other hand, is it too strong? Is the Fed maybe not even going to do the 3 cuts that they said that they were going to do in the December summary of economic projections? Do we potentially down the line, because we're not seeing it right now, do we potentially down the line start to see some wage pressures coming back? As I alluded to, it doesn't seem that we're there. It seems from like the GDP numbers that we've seen the last 2 quarters that we're seeing this almost too perfect Goldilocks scenario: productivity-driven growth, productivity-driven non-inflationary growth. But are you worried that we're underestimating interest rates in this environment of adding 350,000 jobs a month kind of thing?
For certain, it puts a bit of a question mark around how quickly wage inflation can continue to contract, how quickly actual inflation can contract. We've had some good luck so far. We've had inflation tick down, and that's been great. And Powell mentioned that in the press conference. But this is the kind of strength where markets will say, do we really even get 3 cuts this year? Is it more like 2? Or do they all come in the very last part of the year when we have to wait the entire year for them? So again, emblematic of mid-cycle, we're going to be in this push-pull, tug-of-war all year long between, hey, how about some rate cuts? And, earnings are pretty good, so let's keep markets on the uptick. So, very much consistent with what we're talking about.
Yeah, for sure. So I do want to take a moment and actually dig into the numbers that we have here. Bear with me for just a sec as I get the screen up for everybody. But I am particularly curious, as I was alluding to moments ago, about the sector composition here. And so I want to get into some of that, and let me just narrow down the sort of time frame for everybody. 2023, so we can see what we're dealing with here. All right, so this is our sector breakdown here. So one thing I want to point out in the sort of purple up here, again, no surprise in some ways, a huge chunk of these jobs are coming from education and health services. I alluded to this a little bit earlier, but this is an area where you have this sort of structural deficit. This market really needs nurses and other healthcare workers sort of desperately. It just can't produce them enough. So even if we entered sort of a cyclical downturn sort of thing, you would kind of expect that to continue to be a buffer for the labor market in some way, shape, or form. And sure enough, again, sort of blowout contribution from education and health services workers. I'm a little bit surprised by the contribution from professional and business services in green. I mean, that is a big number, 74,000 contribution from professional and business services, 64,000 contribution from trade, transportation, and utilities. That's big. To summarize all of this, I mean, one thing that you can kind of say, you see a negative number for mining and logging, but this is broad-based payroll growth, right? I mean, you do not see a lot of weakness anywhere. You do not see signs of deceleration anywhere. I mean, maybe financial activities ticked down after a strong December, 13,000 in December, 8,000 in January. But with all the measurement challenges around here, I don't know that you read too much into that either. Do you have any observations about the broad-based nature of what we're seeing in this job creation here?
No, I agree. It is definitely pretty much across the board, and that's healthy. And that's honestly, I don't know how you get to that big a number without having some pretty broad-based participation. So it feels like it's the right message overall. But again, I'm just kind of a bit staggered by this number today. It's much bigger than I think anybody would have thought.
Yeah. Let me take a step back and talk about some of the big picture things that sort of underlie all of our assumptions about the U.S. economy and U.S. markets. And the big one has been that, like we're basically 2% potential GDP market, right? And a lot of that has to do with assumptions about productivity. Okay, the last two quarters basically have to force all of us to revisit a lot of those assumptions. Stellar productivity growth in 3Q, stellar productivity growth in 4Q. It's happening for sort of, I think, like normal of this world reasons. A lot of people like to talk about AI and stuff, but AI is still like well in the future. This is happening outside of all of this. Are you revisiting your baseline assumptions of what this economy is capable of, Nick?
No, not yet. You raised the right point about productivity growth. I think that's a very long-term topic, and it needs sort of long-term proof points. And I think we got a big hit to productivity during the pandemic crisis and after the pandemic recession, and we're beginning to make up some ground now. Perhaps people are learning how to work from home a little bit more productively, or employers are figuring out what the right balance is to get employees working productively again. I do know from talking to corporate managements, it's their number one concern. It's a big concern here in New York City, where like people still work from home at least part of the week, and a lot of employers have not figured out how to get the right balance of work from home versus work from office, and how do you get that to fit into a productivity growth matrix. So, but you raised this is exactly the right topic for the longer term, and hopefully AI does have some benefits, and hopefully there are other productivity benefits, because there's only two ways to grow an economy. One is population growth and one is productivity. That's it.
Yep.
Population growth is very slow in the US. So productivity growth is going to be whatever, capacity GDP is. That's it. It's going to define our future.
Yeah, absolutely. I do also I wonder what message the rest of business owners are going to take away from some of the recent corporate news. Uh, Blowout number today. However, you have Meta and you have Amazon, right? And you look at their earnings yesterday and you say, here is an example of two firms that did a lot of trimming recently, and they are feeling vindicated for it. I think Zuckerberg was out there saying, one of the things I've learned from this experience is a leaner workforce kind of works for us in the near term. Um, that kind of thing. I mean, it certainly doesn't seem recessionary. I mean, these companies are doing great, right?
Yeah.
You have Meta coming out and announcing a dividend, but you do wonder whether the learnings of these two companies translates into other companies doing more of that sort of parsimonious trimming, trying to right size those workforces. Maybe in the interest of what they see as greater productivity, not recession fears. But you think that kind of thing could trickle through the numbers as we go through 2024?
Yes, but I think trickle is exactly the right verb.
Mm-hmm.
I covered the auto industry in the 1990s at the old First Boston, then Credit Suisse, and so I understand layoffs for recession reasons and for cost cutting extremely well. And what tech has done in the near past has been very impressive, because they've been able to not just cut headcount and right size the workforce, but keep the machine running on time and keep things growing and keep the business advancing and investing in where they have to invest. So I think in retrospect, we learned that they hired way too many people in 2021 and had to do some cutbacks in 22 and 23, but that's now beginning to pay off. And that's a healthy thing. A corporation has to have the right size of a workforce in order to really grow. Too many people isn't just a cost structure issue, it's also a productivity issue.
For sure, for sure. I I did I was a little bit curious to click through here and see if we could get any more granularity about what was going on in this big jump in professional and business services jobs added, and I'm not sure that I find this answer completely satisfying. I feel like we'll have to do some more digging, but part of it, more than half of it, is the category known as professional, scientific, and technical services. And then you also have a big gain in administrative and waste management here. So you have some ads and things like architectural, engineering, and related services. We know that the construction space has been seeing a lot of movement recently. Computer systems design, doing some interesting things here, and then administrative and waste management. I don't know what to make of that precisely, but I do know there have been some weird seasonal dynamics here. If folks really want to explain away this number, they could say, look, maybe something to do with seasonals or something like that. But I don't know. I mean, the weather was supposed to work sort of against us in January because we had an unseasonably cold month here. So I don't know if you always have these people with a negative bias on Twitter or something that, like, despite the fact that you're creating more than 300,000 jobs, they want to find something negative in the number. Can you find anything like that here, Nick?
No, and I'll tell you, we look at a lot of alternative indicators when we think about the labor market and its current conditions. So we'll look at the initial claims data very closely because that's a lot harder to futz with, if you will. It does get revisions and there's seasonal factors involved, but we look at it seasonally adjusted, non-seasonally adjusted. We also look at a lot of Google Trends in real time. So Google Trends for ask for a raise will show you wage pressures. Google Trends for remote work tell you how much power people think that they have to get remote work. And the report today is entirely consistent with everything we're seeing, which is not only is the official data strong, but the unofficial data, the anecdotal data is also remains quite strong. So it fits all together very nicely. It's this number, I don't think, even if we get revisions to it, this number does reflect a fundamentally still growing labor market, which is all we really care about.
Yeah, good signs out of the beige book as well. Talk to us for a little bit about, you like to call it, I believe, your take this job and take this job and shove it
Yeah.
metric or something like that. When you look at quits, you've done some interesting analysis on quits. Tell us what you're seeing there, Nick.
Yeah, so take this job and shove it is quits to total separations. So when people quit their job versus having their job taken away from them through a layoff or redundancy or other things. And it shows confidence in the labor market. People don't tend to quit unless they either have a new job that pays more or is more flexible, or they're virtually right there at getting that new job. So it's a sign of worker confidence. And as you can imagine, the take this job and shove it indicator went to sky high records during 2021 and early 22 because people were very confident that they could get a new job and could quit. And the great resignation was sort of the tagline of 2022, right? Since then, we've seen take this job and shove it come back down. And it's not back to where it was at the peak of the old cycle, but it's definitely heading in that direction. So workers are losing a little bit of that confidence to say, yes, I can quit and find a new job without really lighting one up. And that again speaks to, the labor market's still fine. We're still creating jobs, but that very strong impetus that people have, that very strong confidence they have to say the labor market's super strong, I can quit, take a month or two off, and instantly find a new job. That's kind of gone, which is a good thing. It's a healthy thing. The labor market shouldn't be that hot.
Okay. Makes sense. So this incredible job creation coupled with the fact that your take this job and shove it metric has been normalizing, another signal potentially of mid-cycle market as you see it, Nick? Or
Well, I'll tell you, the last couple of years have been some of the most unusual for economic history, in the last 100. So it's a little bit hard to say mid-cycle because the last few years, labor market-wise, have been so crazy strong. But it does speak to, okay, when you're in a mid-cycle, whatever happened in early cycle gets normalized out. So unemployment goes up in the early part of a cycle, it comes back down mid-cycle. Rates went down, early part, they come back up, and then they start to normalize and stabilize. So all of this kind of searching around the edges for the right mix of economic growth, corporate profit growth, that is emblematic of mid-cycle, yes.
okay, all right. Let's go to the stock market now. Obviously, market is not the economy, and so on and so forth. But you said, or you said a few minutes ago, you said some of the sector performance dynamics are pretty typical of what I see as a mid-cycle market. This market does continue to be fueled in a big way by tech as well as Mag 7, which are technically communication services, but big umbrella tech. Uh, but there's still like so much agita about valuations. Both from people who aren't looking under the hood. They're just saying like, okay, what is the weighted average PE of the S&P 500, and why does it not look like the 2015 to 2019 average? And from people who are just looking in isolation at the valuations of these Mag 7 stocks. Should people not be concerned about some of these valuations? What would you tell them?
Yeah, look, valuation is always going to be a concern because you want to feel like you're getting a fair price for an asset. It's sort of human nature. But at the same time, we have these things under the hood, whether it be generative AI or the earnings surprises that we're getting from these companies because of cost cutting, that make it very hard to ignore the fact that the big tech companies are doing extremely well and have not only fundamental, things going in their favor, like earnings growth, but also a lot of secular trends as well. And I'll also say that talking to a lot of our international clients, it's very clear to me that in the US, we complain a lot about Mag 7 valuations and their concentration in the S&P. Every other investor around the world thinks it's a positive because they don't have these kind of companies in their home markets. We don't have many in Europe. We don't have any in China, really. They have local heroes, but they don't have global heroes the way we do. And so if you're a global investor, you're looking at these companies and saying, I need to own them for the long term because they're such scarce resources in capital markets. We don't have that many in Europe, Asia, and so forth. So I think a piece of the valuation is just the fact that they are really rare and kind of amazing companies, and the whole world understands that. So it isn't just American capital, American investors pricing these stocks. It's global investors as well. And for them, that scarcity has tremendous value.
Yeah, yeah. And do me a favor, put that in the context of efficient markets, Nick, because you had this great meditation on efficient markets recently. You told a great story about sitting in on some of Gene Fama's classes back at Chicago, and I really enjoyed that note. I also really enjoyed one of the takeaways from the note. Is that if there's one thing that markets really struggle to price efficiently, it's technological change. So unpack that for me. How do you dovetail that with what's going on with valuations today?
So there's a relatively well-known paper now that's been making the rounds for a while, but it's really worth reading. It's like Besson Binder, and it's about 64,000 stocks. And if you look at returns for the global and U.S. market from 1990 to 2020, he takes 64,000 stocks, and he allocates how much of the value creation in equity markets was created by what percentage of stocks. So if you look at the U.S. market, for example, about 2.4% of all value creation in U.S. stocks from 1990 to 2020 was a result of just 2.4% of stocks. So most stocks don't even make T-bill returns. Some stocks outperform, but if you're looking at the aggregate gains for U.S. stocks, all of it comes from 2.4% of companies. Globally, it's 1.4%. And no surprise what these companies are. It's Apple, Microsoft, Google, Facebook, Tesla, NVIDIA. These are the companies that have created all the value in U.S. equities over the last 30 years. makes you scratch your head and say, what's so special about these companies and why weren't they priced correctly earlier? That's what effectively these capital gains show. And the short answer is the one you mentioned, which is the one thing markets have real trouble pricing correctly is where can technology grow? How much can it grow? How much can it impact our lives? Because it's kind of hard when you're seeing Apple in 1990 to think, okay, one day there's going to be, laptops and phones and everything else. And so it's just, that's the only thing markets systematically underappreciate and get wrong, which is why stocks continue to work. It's technology, and that's why the valuations are what they are too.
Okay. All right. So Nick, with our final minute or two here, do me a favor and try and take us home here, right? We just got this incredible jobs number, another incredible jobs number, frankly, coming off the back of an incredible GDP number, another incredible GDP number. At the same time, we come into this year with a lot of folks, certainly sell-side strategists, convinced that the S&P 500 does not have a lot of upside. How does an economic story like the one we see developing before our eyes impact the base case for those U.S. equities in your mind?
Sure. I mean, if you have to think about what drives asset prices, what drives stock prices, it's one word: it's surprise. Things that weren't anticipated, which end up happening. We're getting a lot of economic surprises because the economy is still growing pretty well. And so if you take the idea that the only thing that moves asset prices is surprise, we're going to keep getting surprising numbers. We're going to keep getting surprises to the upside, like today. And against that backdrop, it's really hard to dislike U.S. equities because we're getting upside surprises. One day we'll get downside surprises. We always do. Recessions always happen. It just doesn't seem to be happening anytime soon.
Yeah, that's for sure. You said it, Nick. Well, listen, with that, thank you very much, Nick Colas of DataTrek Research. Really enjoy your work always, Nick. Thank you very much for tuning in, and